Okay, Kathryn Rooney Vera is Head of Research and Chief Market Strategist at Baltic Capital Markets, joining us live from Miami, Florida. Kathryn, it's great to have you on the show. Thank you very much for your time. Evening your side. Weigh in on this discussion. It's less about whether rates are going up, but more about when, and how are you thinking about the process from here?
Well, it's inevitable, as you said, Tanvir, but I think it's very scary for the markets to even contemplate the possibility of rates going higher, much less both a tapering process and higher rates. But as you said, it's an inevitability. The thing is the Fed wants to avoid it as long as humanly possible. My concern is on the inflation front. I heard you and Nancy discussing this, and you're right. However, we have to remember that there's already $6 trillion over the past 12 months as a response to COVID here in the United States committed, not entirely executed, but $6 trillion committed. We have a fiscal deficit in the United States of 20% of GDP. That's astronomical and higher than anything we've ever seen, even in times of war, such as World War II, even in times of the Lehman Brothers' massive global financial crisis. And that's on the fiscal side. On the monetary side, we have rates still committed to, basically zero for the foreseeable future, with a concurrent commitment of $120 billion of asset purchases for the foreseeable future until we get some massive jump in inflation. I'm talking 3.5% to 4% year over year. Don't expect anything to change.
Okay, so that seems then like a far cry for rates to go up, because I think most analysts on the street are working with the assumption that by the end of 2021, early 2022, even 2023, the rise in inflation would be contained to 2.5% at most. Do you believe that to be the case? And all this money supply that's coming in, and by the way, I'm with you on that $6 trillion number. Do you think at some point in time that would lead to inflation overshooting?
Yeah, so we do have some transitory factors, which I'll mention, of course. Those are the shortages, both in human and equipment capital. So there's that. There's also base effects, but there's structural forces here at play, both from the monetary and fiscal side, but also the demand pull inflation, which is this ricocheting of the U.S. economy. We are de facto in a V-shaped recovery. As you mentioned earlier, we have 6.4% growth in 1Q. More likely than not, for entire 2021, the economy grows above 6.5%. So all of that is inherently inflationary. You mentioned M1 and M2. Both of them are growing in high double digits. The reason we haven't had inflation, as per my studies back at Baltic, is that velocity of money has crashed down. And we're finally seeing velocity of money tick up. And as the U.S. consumer starts to lever herself up, okay, because we've seen a deleveraging process unlike anything we've seen in 3 decades. We're at record low leverage ratios versus discretionary income. Once that starts to pick up, I do think that we're going to get a sooner rather than later jump in inflation. And my bet is that we see above 2% over the course of the next 12 months.
Okay, Kathryn, then what do you want to do with your portfolio? I mean, if that is your belief, what looks like the safest bet?
So we've been right in telling clients over the past 6 months to start hedging your long equity portfolios for this inflationary scenario. TIPS have made record highs, and if I'm not mistaken, in the past 5 years, the last time I looked at the data. So TIPS have been a phenomenal instrument. I would say hold on to them and accumulating them. Those, of course, Nancy, being the Treasury inflation-protected instruments, as well as those sectors and those industries and those companies that most historically benefit from inflation. So companies that can pass along those higher costs, consumer staples, materials, real estate, alternatives with lower correlations to the market, such as commodities, even Bitcoin, even gold. These are some historically asset classes that historically outperform in inflationary scenarios. Buy them while they're cheap, not when everybody wants them, when we're in, the perfect storm of inflation.
Kathryn, that does seem to be more and more the consensus we're hearing right now. I mean, evidenced by the fact that tech has been the laggard in the last few sessions. People are rotating out of those high growth names. But there may be a temptation to get back in on some of those names, too, if we see further declines. What would you advise people to do?
So the advice that I'm giving is the barbell strategy, because the Fed is unlikely to change anything until we get that big boost in inflation. We're not talking 2.5%. We're talking the Fed is forced to move rates when inflation jumps above 3.5%. That's my view. And that's not going to happen for the next 12 months. So you do have a 12 to 18 month time frame, in my view, to keep this party going, which has been so inherently bullish. We've seen monetary policy and fiscal policy de facto take markets to record highs, and that's unlikely to change soon. So stay long equities, overweight equities, but hedge yourself on the more cautious side with these inflation-protected instruments and with defensive sectors such as consumer staples.
Yeah, I was just looking at some numbers, Kathryn and Nancy, with regards to the trade balance as well in the U.S. for the month of March that came in at a record $74 billion. That also tells you about how sticky demand is stateside. Are techs a buy on dip?
Look, when the NASDAQ dropped 10%, I did recommend, and we did recommend buying on dips. Tech, I think, is something that one wants to have in their portfolio in a structural manner, meaning for the long term. So I would say that, yes, you do want to stay in tech, which is, of course, a quarter of the S&P 500 in terms of its weighting. So stay long tech. But certainly hedge yourself with different asset classes. You referenced the trade deficit, the fiscal deficit. We have a lot of deficits here. We have a U.S. government that's spending like it's like there's no repercussions, caution to the wind. So really all of that is negative for the dollar. So when you have a weakening dollar and you have global growth, then you should have a position in commodities as well. So that's one thing that I would say. And even cryptocurrencies, that's certainly taken the splendor out of the appeal for gold. And I think we want to buy on dips there as well, just to have a piece of that going forward, because it is so correlated to both inflation and to the performance of the U.S. dollar.
Yeah, and Kathryn, just on that, do you have a preferred play in the crypto space? Because we've seen Ethereum just skyrocketing over the last few sessions to records.
Yeah, I don't look specifically into the specific currencies, but I would think that Bitcoin is the one that we want to be most focused with, rather than dabbling in all the other innumerable currencies that are out there. But I do think that it's taking the place of gold as an inflation hedge, and it's also attractive for its appeal as something that's unregulated but still transparent with its blockchain technology. So my recommendation is just to incorporate that to some small extent in the proportion of the portfolio, which should be large in itself, directed towards alternatives. Alternatives as an asset class are, of course, private equity, venture capital, commodities, cryptos. It incorporates a wide variety of asset classes, but the point here is to get some exposure to an asset class with a lesser correlation to the broader markets. And I think that's going to be critical once we do get that correction and the potential rollover both of markets and the economy in 2022.
Yeah, but given those 500% 12-month gains, some may look for a little bit more of a dip to get in, I wonder. Kathryn, great to have you on the show. Thanks so much for your time. That is Kathryn Rooney Vera of Baltic Capital Markets.